The housing market can feel a little bit confusing to almost everyone right now, both buyers and sellers.
And the decisions that people make today can impact their budgeting, their cash flow, and their long-term plans in very different ways.
So in this episode, we're breaking down what's actually happening and some things you need to think through before you make a big move.
So today we are going to cover several topics on the housing market, but toward the end, we are going to cover the current housing and interest rate environment as well. So today we're joined by Braden Thibodaux, and he's a mortgage broker with Fairway Home Mortgage. Is that right?
Mm-hmm.
Well, how you doing today?
I'm doing good. Doing great this morning.
Sweet.
Thanks for having me.
Thank you for joining us. As financial advisors, there's a lot of things that we help with planning for home purchases and things like this in a broader context of a financial plan, but getting the perspective of someone that goes through the process, I think is going to be highly beneficial for our viewers. And so we just appreciate you being here.
Well, thank you.
You know, Eddie, many times we'll have clients come in and a home purchase for somebody is the biggest purchase of their life. You know, and when people have investments that they've entrusted to our care and such, it happens really frequent where people will come in and they want to talk about their retirement, their investments and such, and then they'll say, hey, we're getting ready to move this property, and they're going to ask for advice. And so that's one of the benefits that I didn't ever realize that having a real estate license was going to come into play being here, but being able to give people insight and advice from a real estate perspective has been very helpful. And I think that's one of the reasons why we were so excited about having you on, is to be able to help our clients to understand, and just a broader audience to understand not just the financial investment side or the real estate side, but also purchasing a mortgage. What does that look like? How does that affect you overall? Because all of these things are intertwined. None of it is sequestered by itself.
Yep.
You know, they all work together.
Yep. Braden, tell us a little bit about your background and how you got into the mortgage business.
Yeah, so I actually left school, and my mother is a State Farm insurance agent, and I started running up the State Farm ladder.
Oh, cool.
And ended up training some larger agents teams in Austin. My wife's job led us to Austin. There's some very large agents there. And the next step was to become an agent at the time. And there was a big transition in the organization, and it was a lot harder to get your footing as an agent at one time with State Farm. And basically, State Farm had a bank, and they were doing mortgages. So one of the ways to help agents was to get mortgage licensed. So I took the test. And at that time, State Farm kept their loan officers at a distance. So they had their own team, and we were more aggregators for business.
Yeah.
But I was newly married, working probably double the work week hours, somewhere closer to the 60 to 80 range.
Yeah.
And just one day woke up and was like, life is too short to be 20 in my young 20s and feel stressed. My 60-year-old agent was stressed about life, and I called my mother and I was like, hey, I don't think this is for me. The investment to get into agency is a little overwhelming, and the success rate was dropping at that time. And she was like, hey, you have your mortgage license. Have you thought about it? And I actually enjoyed the little bit of soft work that State Farm let us do at the time. And I went home and I told my wife, I said, I just need you to trust me. I'm going to quit my salary job. And we were just like any newly married couple. We had nothing, you know? And so it was a huge leap of faith. I quit my job on November 1st of 2017 and got my first transaction 3 days later.
Oh, wow.
And never looked back.
Never looked back.
Nope.
Wow.
Yeah. We were living in Austin at the time. So it was a scary jump, but that's my story at least. I didn't want to do the State Farm stuff. I didn't want to work 80 hours.
It's amazing to me. I have a similar background. We're not going to get into it today because we're here to talk to Braden. But it's amazing to me that through those hardships and through that, I guess, lack of better term is darkness, right? You're going through that. I don't want to be here. This is hard. I don't enjoy what I do. But through that, the Lord opened the door for the career that you have, and now you're loving life. So it's just awesome.
Yeah.
So.
We got to reclaim a lot of my time, and now with 2 daughters. I can't imagine doing anything else.
So on the mortgage brokerage side, can you tell us like who's your customer base? Who exactly do you serve? Where do your clients come from?
Yeah. So Fairway, we're not a broker, right? Like a middleman. So it's our money. We lend our money. We do a lot of agency direct. So directly to FHA, directly to Fannie and Freddie. Then we have a mix of specialty products as well that are ours. And so my customer base is there's almost no loan I can't do. We don't do land.
Yeah.
You know, that's more of a local banker credit union specialty, but my base is large. I think that the thing I enjoy most is first-time home buyers. I had a terrible experience my first time, and just keep that in the back of my head, and then try to do a lot of explaining, listening to people when they talk. You can hear when something doesn't land, right? Or something's more confusing than when you said it the first time. And so taking your time with those people, and then higher level clients who have a more complicated portfolio, it just works well with my brain, and I enjoy talking to those people more. They have a higher level understanding of money, and it can be fun to be creative with those people.
And it makes work more enjoyable, not only for you, but probably for the buyer when you connect with your customer, your client, right? So I find that in our business as well. So let's start with the landscape today. What are you currently seeing out there on the mortgage side, right? On interest rates, buyer behavior, and home supply?
Yeah, let's start with buyer behavior.
Okay.
Buyer behavior is still, I think, they're apprehensive, right? I would say that rates are not at an all-time high, but some other variables are. So rates are good. A 6% or a range plus or minus, 1 or 0.5%, something like that, is not a bad interest rate for a mortgage, but
well, there's a lot of people too that have never seen that.
That's another thing.
And I'm going to talk about that here in a minute, but I think some of that's psychological.
Absolutely it is. So the rate itself, people are very sensitive to the rate itself. But I think what is really creating that apprehension is that we're coming off of massive pandemic appreciation in the real estate market, which also created a massive constraint in inventory. And that's just basic supply and demand dynamics. The real culprit, I would say, to the apprehension is that home appreciation got out of hand, right? Yeah. It created a lot of wealth for people who were already homeowners. But then you have a generation of family formation in their 30s where people are trying to buy houses and they missed that equity. They didn't get the equity from the appreciation. So they're buying a home at what is pretty much a historical average of rates, but at a point where homes have never been more expensive than they are today. So
on a comparison basis,
basis.
Yeah, because even though homes were less expensive, like when our parents bought them, for example, the amount of money they made comparative to the home price, that discrepancy is wider today even than it was back then.
Significantly wider.
Yeah.
Yes. Yeah. We're in a crunch for sure. Our parents could buy homes on a single income. Most people are buying homes on a dual income household now. And even then, finding it elevated and difficult. So I would say that that's the general sentiment out there is people need a little bit more hand-holding through their budget. I'm talking more today about overall household budget than ever before.
Oh, we see it.
Yes. So the general rate environment, they're stubborn. Right. I think if we go back to 2022, mid-summer, when they started creeping up and they hit 5s and everybody was shocked, the advice at the time, I think across financial networks, across people who study the mortgage industry, was that this was short-term. Inflation, turns out, wasn't transitory, but we'll get it under control fairly quickly. And these 7% rates that they ended up getting up to by December of that year, they'll go away, right? Like take the note now,
that's what they were saying
later.
Yeah.
There was a popular saying where people were like, marry the home and date the rate. Turned out to be not great financial advice in retrospect, right? Because rates are there.
I mean, so now if someone is purchasing a home and they don't plan, like we were talking about this before the show, if someone's gonna pay more or something like that and they can afford to do that, but what you're talking about is like that first time home buyer that they can barely afford the house to begin with.
That's it, right? They were buying the home on a dream of refinancing it soon, right? So the marry the house, date the rate is not inherently bad advice, but the expectations didn't quite
you have to put it in context over time. And if you think about whatever rate you're going to get, say you apply, you get approved for 7%. Well, if mortgage rates go up, you feel like you got a good deal.
That's it.
If they go down, well, now you can look at refinancing potentially, just depending on your context, depending on your situation. I think what people are having to really take into account is, what is the rate I get right now? Can I afford that?
Yes.
For the term of the
long
loan.
term. For the long term.
Because it may not change. And if it does change, it might go up.
Yes.
And so I need to know that I can afford this amount over the life of the loan.
We talk a lot about behavior on our show, and behaviorally speaking, people through the dream sit there and say things like, oh, I can afford that note. And usually when you're looking at something like a house, I've done this before. You look at a house and you're like, man, I can afford it. That's my dream home at the time. That changes, by the way. But then you're like, you do all the crunching. You talk to somebody like yourself, or you go online and you do some calculation. But then you get to crunching, and we always crunch those numbers to our favor, right? And then we get blinded by the fact that these taxes and insurance and everything, they are not going to stay stagnant.
That's right.
They're going to go up. So it's not just the note today. I've got to pay these other expenses. And by the way, now you own, so all those repairs are yours.
They're yours as well.
And it's not on someone else. And those considerations, we know they're there, but we just kind of like act like they're not.
That's it. I think maintenance is not something that's talked about enough in the mortgage industry. So when I'm going over a budget, especially with a first-time home buyer, people who have owned several homes, I don't have to talk to them about the exact same things. But 1% of your mortgage amount or an extra note, let's say, factor that in. So if your budget's $1,400 a month, maybe you should buy something that's $1,200 a month, because you're going to have some maintenance.
With the clients that I've been having recently, to explain to them, you might get approved for $225,000. That does not mean you can afford $225,000 and the note that's going to require. You can get approved, but that doesn't mean that you can afford that. And to your point about the extra expenses that maybe a first-time home buyer doesn't consider these maintenance, what I'm seeing to prove that point definitively is when we get the inspection report back, and you're buying a 25, 30, 40-year-old home, and it's 45 pages. And that first-time home buyer looks at this and goes, who's going to pay for this? And then it dawns on them, the face turns red, they get that tingling down their spine, and they go, I'm going to have to pay for this. And then they start calculating and go, oh, this is not a $225,000 project. There's $30,000 of expenses here. Like, I can't afford that. Or I'm going to have deferred maintenance. Where am I going to come up with this money? I got approved for $225,000. I don't think I can afford that.
Well, and I don't know if enough folks stop and think, this may not be the last home purchase I make.
That's right.
So in that behavior that we're talking about, they're like, well, I want this. But if they bought this, before they buy this, then maybe they can afford this down the road, the higher mortgage and everything, because now they're going to have equity they can then transfer into a new property. And I don't think people want the process.
That's right.
A lot of the times they just want the now.
Oh, for sure. Absolutely. I do think inventory is getting better to a more sustainable balance in the supply demand dynamic.
Because it was way out of whack. There's way more people looking than there were homes before.
Right. And that's the real culprit, is that we're not building enough houses to match household formation. The slowdown that took place over the last 3 years really helped inventory creep up. So it's not as severe of a problem, right? It is still a problem. We're still not building enough houses. But the dynamic's getting a little bit better. And I think what that's flipped to is, to bring it full circle with inspection reports, is you're seeing the ability for buyers to negotiate a little bit better terms than they did during the pandemic.
Yeah,
that's right.
Yeah. So the only, I would say, bad time to buy a house is when you're not ready. Because otherwise it's a roof over your head for your family. But when people just jump into it, wake up that morning, and that's the first time they're talking to me, is the first time they've thought about buying a house. Slowing down can be very wise.
And we talk a lot about that. Slowing down, breathing, thinking, maybe sleep on it. Because when do we make the worst financial decisions?
Oh, on a whim.
On a whim. Coming from a different source.
Yeah, it's always on a whim.
But
you can hear it when I talk to people. I can tell if this has just now crossed your mind.
Yeah. So given all of that, family comes to you, what should they be prepared for when they're getting ready to look at purchasing a home?
I would say the first thing is to think about what you have left over every month.
Well said. Yep.
Yeah, because if the answer is that it's a struggle already, or that you have very little left over, I think having kids, the one thing it for sure taught me is you don't know what expense is coming your way.
Kids teach you a lot.
You don't. They teach so many things, but for sure, those little boogers, they can be expensive. And so I think that knowing what you have left over is a great place to start, mostly because that tells me what you can save, but it also makes you think about what you're expending.
Yeah.
And for someone with their first time, we're talking about their whole budget. When I pull someone's credit, I see all of your debts, even the afterpays or the buy now, pay later type things show up on your credit report. And so I can see holistically how you're spending your money. Once we see your bank account, we can see how you're saving your money. So we're talking a lot about, if you buy this house, have you thought about refinancing your vehicle or reducing other costs, right? To get your whole budget under
control.
Under control, yeah, within means. That's probably the very first step. I would say the second step is to talk to a loan officer before you go look at homes is really good for the expectation setting process. Like, just because you can buy $225,000 doesn't mean you should. But if you go look at a $225,000 house versus a $175,000 house, you might want to spend the $225,000.
Why do you think most people don't do that?
I think that we're built to consume.
That's right.
In this society. And so we think about consumption first. So getting into what life will look like, the dream of being in that house, what that means for your kids, what that means for your outdoor activities, or that shop that you want to do all your woodworking in, like any of those things, you think of those things and you don't think about paying for them.
That's right.
Right.
You don't.
Or what it's going to do to that family you love 5-10 years from now.
Right.
Right.
So to that point about not considering before you start consuming, you just consume. You consume with the eyes.
Yeah.
You consume with the pride. You consume with your hopes. To put a concrete example, I've had some clients before who get approved for a certain amount, and what happens? Well, the desire creeps up to meet that amount.
For sure.
And so, well, we got approved for this amount. Let's go look at houses that they're asking for this amount. So we go. We go and look. And you can't help it. You take a family to go look at a house, and the husband's looking at here's a crack. There's this that needs to be fixed. And what the lady sees is she sees her kids running around.
Right.
She sees how that bedroom or how the living room is set up. She sees how she's going to decorate the kitchen. And what is she doing? Well, she's attaching her hopes.
Yeah.
And then whenever all the costs come together, it's crushing. In fact, I would say this, there is a grieving process.
Yeah.
It's very difficult. And then I've had some other clients, and I think this is wise. They say, look, there's this house over here. I think I would like it if we go look at it. I don't know if we can afford it. I don't think it's wise for us to go look at it. Yeah. And they say, because we don't want to get our hopes up. Because when you get your hopes up and your expectations up, you can end up making some bad financial decisions because you lead with emotion rather than truth.
Yes. Yep. Yeah. To that point, when I'm talking to anyone, and I've gotten braver, right, over the years, I'm more confident than when I started 10 years ago, right? Almost 10 years. So I'm better at handling, in a really polite and respectful way, the conversations around ego and what you qualify for. Because I get the question almost every time where people are like, well, how much can you qualify me for? And people are sometimes asking for two reasons. Sometimes it's just an ego thing. They just want to know, right? What can I afford? The second thing is I think sometimes people are gauging loan officer skill level or capability on who can offer them the most money.
Right.
And I can tell you almost successfully, I never answer that question, because the way I approach the conversation from the start is, when you think about what you can afford, what's the most you want to spend on a monthly basis? Because the conversation of can you buy a $500,000 house versus I don't want to spend more than $2,200 a month are not the same.
Right.
A $500,000 house is not $2,200 a month, right?
Right.
So I almost always talk about what's the most you're comfortable with, and we start there, right?
Because a lot of people don't know how to work the math back. They get in their mind, I want a house that costs X, but they don't know how to do that complicated math that we all learn, or you at least learn how to use the calculator for, to run it back and say, okay, what does that mean to my budget every month?
Right.
Or what are the things, like we said earlier, that you need to consider on top of that?
Right.
Right.
One factor that we consistently look at when we're working through financial plans for people, we constantly go back to the tab that says cash flows.
Mm-hmm.
Cash flows. After this, after you add this expense, if you're going to take Social Security here, what's your cash flow? We're always going back to that, because in this context, what you don't want is for somebody to become house poor.
Yeah. It's like not having any gasoline in your car. I mean, there's no fuel to run your life if you don't have extra cash left over at the end of the month.
Yep. Absolutely. I would say that when Jordan and I are discussing a client, always when I give Jordan an amount, just filling in the blanks for him on my conversations with clients, the amount that I give Jordan is probably not the amount they qualify for. It's probably less, because we focus so much on their budget. I always let them know, this is not the most. If you want that payment, you need to buy a home that's around $225,000 plus or minus a little bit. But that's not the most. If we want to revisit this conversation, that's open. So I don't ever shut people down and say, you can't. I won't issue a letter for whatever that amount is. But the conversation always centralizes around their budget. Yeah. And that's because when I decided to do this, I want to serve the people in my community. Mm-hmm. I want to be able to go to a restaurant and sit down and see my clients, and it be a good interaction, a positive interaction, and not one that says, hey, that home that you gave us a loan for less than a year ago, we sold the home because
much different, by the way, if you're talking to 1-800 whoever what, right? So,
for sure.
I mean, because they're never going to see you again.
Yeah, a lot of the times too, to that point, I'm not a customer service representative, and that's a great job. It's a necessary job, but it's a bad job in conjunction with the biggest purchase of your life, or something as complicated as obtaining a mortgage. All the different products are the ins and outs. And so a lot of times the people that you get the mailers from or the spam calls from, they're just out there slinging loans. They don't care what they're signing you up for. They're not going to see you and your family. And I do think working with someone who maybe has a little bit more skin in the game in that context, someone that I would hope would want to have a positive interaction with you out in the community, is probably going to protect your financial interest, assuming that they also are competitive.
Yeah, you don't want to be like paying extra fees and rates just for the sake of it.
Yes.
But also you get what you pay for.
You do. I would never want someone to make a compromising financial decision to support me because I'm local and in their community. Yeah. So we have to be competitive. Yeah. But you also want someone who's taking time to understand your situation and spending some time to get to know you. Mm-hmm. Yeah, a lot of the conversation just all about the budget.
Shifting gears just a little bit. So mortgage rates have come down post-pandemic, right? A smidge.
A smidge.
How do you see the movement in interest rates affecting buyer behavior? Is it at all in your realm?
It definitely does. I think that you see a little bit of application momentum, as in people inquiring, not necessarily the follow through. Mm-hmm. You do see a little bit more application traffic when there is some movement downwards in rates, and it works opposite, of course, when it goes up. The funniest thing I notice is that a lot of these financial websites like Yahoo Finance, people don't understand how much clickbait articles are on there. And so I'll notice that in my daily news reading, if I see an article that says mortgage rates have dropped, what does that mean for you? Yeah. Even though I know, as someone who works daily and watches the mortgage-backed security market, that rates haven't gone down, I will see an uptick in inquiries, like immediately. Yeah. So I do think consumers are very sensitive to that news. So it does drive traffic. I would say that year over year transaction wise, even though rates have crept down, it's relatively flat. It's relatively flat.
I'm interested in it because I had a theory. Last year, before the Fed cut rates in September, my wife and I, we normally walk around the neighborhood and we see all these for sale signs going up for homes. People trying to get out. Probably, just my opinion, that people bit off more than they could chew, whatever. Mm-hmm. Maybe not. Maybe they got a job relocation and that forced them out. But I know it wasn't just because, hey, I want to go pay more on a mortgage. Right. But all these for sale signs are going up. Some of these houses, man, they've been sitting there a year.
Yeah.
And she's like, when are some of these houses going to sell? I said, I'm not in that business per se, but I know the things that affect it. And I said, to me, we've been spoiled the last almost decade, spoiled with these low interest rates. Mm-hmm. Federal Reserve had interest rates at zero. The whole yield curve was down. And so that's the new normal now. For a certain generation, my thought on it was, well, there has to be a long enough lag psychologically for people to get used to maybe it's not going back to 3. And then when that kind of sinks in and you're at 7.25 long enough on a 30-year mortgage, then 6.5 starts looking pretty dang good.
It does.
And so maybe the new normal's 5.5 to 6.5, which is historically what?
Great.
Yeah.
It's historically better.
Yeah.
Independent. That independent variable.
But it's all relative to the environment you grew up in or you live in, right? But to your point earlier, home affordability is a lot lower too.
The prices of homes appreciated so much. During COVID, you had bidding wars. People were receiving $10,000, $20,000+ over asking price, and it just inflated everything. Mm-hmm. What I'm seeing on the agent side, listing and buying, is sellers are not getting nearly as much interest as they thought that they would.
Yes.
And so let's just say they listed the house at $300,000. Well, I think people are coming to understand, at least in my experience, they're coming to understand they're not going to get 300. And the amount of movement in that listing price and then what it actually sells for, it is very significant. And I think that with supply and demand, it's just the demand is not there because people can't afford. And that house just sits there and they see that cumulative days on the market. And I know as a realtor, I'm telling my clients, hey, this house has been on the market for 500 days. Let's not offer 300. Let's offer 240.
Yes.
And sometimes some people would say, well, that might be insulting. That actually might be a rescue parachute because that house has been sitting there. You're talking about the houses in y'all's neighborhood. Goodness, if you've been sitting on that, where are they living? Mm-hmm. If they're not living in that house, they might be paying 2 mortgages or they're paying for a small apartment and a giant house that nobody lives in, and they're willing to take a hit on the equity they thought they had, but it's really a phantom equity because they're not. If you can't get your money out, that's not equity.
Well, probably the only reason that those prices aren't avalanching down right now is because of the lack of home supply.
Yep.
Yes.
Like 2008 was different because there was oversupply of housing. And so it was real easy for somebody to jump ship and go from one house to another or just walk away from it altogether.
Yeah. It would take significant economic turmoil to repeat 2008 under the current supply.
Yeah.
You wouldn't be worried about your house.
Yeah. Talking about the mortgage process a little bit, what are the factors that are most impactful for someone to get approved?
The most important is your credit score. Your credit score is going to determine what type of loan programs you qualify for to meet the minimum entry threshold for different loan types. Mm-hmm. It's going to affect your budget. The higher your score, probably the better your budget looks, right? Or the more home you can afford under that budget. So your credit score is going to be the most important. Your credit history, so that's like what is inside the report, is going to matter very significantly. You can have actually a pretty good credit score and have a Chapter 13 or Chapter 7 bankruptcy. Mm-hmm. And that'll change the terms or what type of loan products we can offer. So what you have on your credit report matters. I would say that employment is probably the next most important thing because we have a lot of programs that'll help us cure the assets question. I can originate loans with all different levels of savings.
Yeah.
But the type of employment you have matters greatly, whether in the most basic form, it's a W-2 job or a self-employment job.
What changes? That brings up a good point. So what changes? Say there's a person works at one of the refineries around here or something like that, and they're retiring. So they're not going to have that W-2 income, but they've got the savings. They've got IRA, 401k, whatever.
Yeah.
What changes in that
That's
aspect?
like my favorite type of product mix, because when someone has accumulated wealth and assets and they're entering that new phase of life, they worry, can they even buy their forever home or their retirement home or downsize because the kids are out of the house? And when you have accumulated assets and you're entering that retirement age, there are some really cool things you can do with your wealth to create an income stream. You don't even have to utilize it. So if someone has $1 million in a non-employment retirement.
So just to specify, that means not in a 401k,
Not in a 401k.
403b, something like it has to be in an IRA.
That's right.
Okay.
Fannie and Freddie, so conventional guidelines, they allow us to create income streams without you having to call your financial advisor and actually create the withdrawal. So if you have $1 million in an IRA and doing a loan with Freddie Mac, let's say, I can just divide that by 240 and create an income stream.
Oh, wow.
And all I have to have is proof that you have the money and access to it. Those people have a lot of options. In that specific situation, there's lots of options where you can forego your primary employment and still be able to create an income stream to qualify for a mortgage.
Okay.
And never have to call and actually make the withdrawal.
So, for example, if it's one of my clients and they're shopping for a mortgage and they come see you, they can get all that done. You're not going to have to call me for a letter or anything.
The times in which we need a letter, okay, is because there are two different guidelines. So the one that I spoke for at first is called assets as qualifying income. Okay, so that's where we take your assets, we create income, a mock income from it under very specific formulas. The time in which we would approach a financial advisor for a letter is when, let's say that they have enough to support 36 months of income, of whatever that number is we decide. So if I need $3,000 to qualify you for the mortgage you want, you would need enough assets available to have $3,000 36 times.
Yeah.
And that's when I would get a letter that says, we've initiated a monthly withdrawal from this account for this amount of money.
For that amount of money. Okay.
Yep.
That makes sense.
Yeah. So there are two different, scenarios in that case.
Okay. We've talked a little bit about refinancing. What are some of the metrics, measurements when somebody is considering refinancing that would trigger them to say, this is a good decision?
There's only one metric.
Gotcha.
Time horizon. That's the only thing that matters. So if you want to refinance, the only question to start the conversation with is, how long are you going to keep this house?
Okay.
That's it. If you are planning to move out of state in a year, there's no amount of drop in rate that's feasible. That is going to make it worth it. If you're going to stay in this house for 7 years, then there's options to consider. So time horizon is the most important factor.
Well, the curveball or the nuance that I've seen too, I'll give you an example. The other day I had a client call. He said, hey, Eddie, I came into some money. I owe $180,000 on my home. And I want to use this money to get rid of my mortgage. So they owe $180,000. They got $100,000. They can afford the monthly note. His thought initially was, we're just going to go refinance. Now, I said, we really need to think about that for a second. Do you have any problems affording the note now? No, there's no problems affording the note now. Okay, well, if that's the case and you put $100,000 on a $180,000 mortgage that, you might be 5 years into it on a 30-year, but if you then refinance that $80,000 over another 30 years, that may not be the best thing, because on the amortization schedule, you're jumping way down here. It's like starting over on that 80.
Starting over.
So I think that's a little nuance that people don't consider. They think, I'm going to really help my cash flow because I'm going to refinance, but then they don't think about what that's going to do
to their long-term interest.
To the long-term interest.
That's right. I think a lot of times when people are interested in lowering their payment and they've done a conventional loan, something that most people don't even know about is recasting.
Okay.
It is not a refinance. So all your terms stay the same. even the remaining term that you've already paid into, you can put that additional $100,000 down in this case, and they will recalculate your payment.
Oh, okay.
So you're obligated to the lesser payment amount. You're going to pay less interest because you've paid the principal down. And most servicers charge like $250 to do that.
Oh, wow.
And so your mortgage statement will show the lower payment after recasting, and you don't have to refinance. And $250 is significantly more cost effective than refinancing. Only available to conventional loans. It's a great option for people who come into inheritances or sell another asset.
That's great information. So let's talk a little bit about mortgage products. We talked about recasting. What are some different tools that you have in your quiver?
Bridge loans are becoming more and more popular now, where people are willing to take the risk of 6 months to a year to sell their house, but they don't want to wait to buy the next one. Bridge loans bridge that gap where you borrow against the equity in your existing product to leverage that as a down payment in your next one. That's becoming a more common product. You're seeing a lot of home equity products now where people are like what they've always done with them, which is buy things or upgrade their home or different projects that they might have with the house. Every once in a while, you can actually, if you have enough equity, do a home equity loan.
Okay.
And actually get a better rate with almost no fees than a refinance. For your clients that did put significant money down when they bought the house, sometimes a straight refinance, rate and term refinance into a traditional product is actually a worse option.
What's more popular right now with people?
I would say the 30 years never been more popular.
Okay.
Yeah.
Because of affordability.
Yeah. No, I wish people did 15-year mortgages like they did 15, 20, 25 years ago. But the 30 years like the staple.
Okay.
Yeah.
Speaking of loan products, I found it interesting that you said the single most impactful factor when considering a refinance is time horizon. But that's not what you hear amongst people on the street. The typical lingo is if you can drop 1 point, that's when you should do it.
Yeah.
And I find it interesting that your answer is it's time horizon unequivocally, because what we tell people when we're giving investment advice, we say the single greatest impactful factor when it comes to your investments is time horizon. So I'll ask you this question. I think we already know the answer. Certain government employees have floated the idea of a 50-year mortgage.
Terrible idea.
Why is that a terrible idea?
First of all, it's not pro-consumer. That's pro-bank, right?
Who's ever going to own that home?
The 10-year-old who buys it.
Yeah, for sure. The 30-year product is already a question that we're asking, will you ever own your home? So why would you float a 40 or 50-year loan product out there?
Because most people don't stay in their home 30 years.
That's right. I think also people forget that loans are front-loaded with interest. So the person, again, who's making money off your dollars are the banks or whoever owns this product.
Which is why I brought up earlier, if you can get a smaller property that you can then pay more on that mortgage, say the home you really want, you're going to pay $3,000 a month on. If you can pay $3,000 a month, go find one that's like $2,000 a month, $1,500 a month. Pay $3,000 on it.
That's exactly right.
Build up that equity, then turn around and use that equity to get the house you really want, along with your additional savings.
Yes, 100%. The float there with a 50-year product is that it creates affordability, but it doesn't. When you look at the median home price across the United States, so we're not even talking specifically to Texas or Southeast Texas, but on the higher amount, the savings is like less than $300, in most cases less than $200, and you're paying a house for 20 more years, something you will literally never own. It will not increase demand. It will not increase transactions. It's a terrible idea. Because I'm a mortgage lender and my job is to originate home ownership, renting is still a roof over your head for you and your family. So if it allows you to budget better and it's more affordable, and
sometimes you get a nicer apartment or something than you can a house at that rate.
And when you get in that apartment, who does the maintenance?
Right.
The guy that owns it.
That's not how typically the consumer reacts.
Sure.
I've got this image going through my mind right now on Willy Wonka and the Chocolate Factory. You have each of these kids is known for their virtue or their lack of virtue. And I keep thinking of Veruca Salt. And what does she want? I want it now. What does her dad do? Her dad gives her everything now, and it gets her in trouble when she finds herself outside the factory. And a lot of people, that's how they get themselves in trouble.
Absolutely.
I see the house that mom and dad have, grandma and grandpa have. I want that now.
Yeah. Yes.
And somebody will give me a loan.
Yeah.
That means I can afford it. That's not good logic.
I think that's another important misconception to talk about too. The people who set our guidelines for lending, they are not thinking about affordability.
That's right.
Someone is advocating for the consumer. That's not the loudest voice in the room, unfortunately. Right. So with FHA, I can do 57% debt to income on your gross income. Average American pays 14% in total taxes. That's across all incomes. But if you're buying a median price home in Southeast Texas, you're paying more than 14%. So let's say that I can lend you 57% debt to income on 80% of your gross income, let's say. It's insane. To Jordan's point, just because you can afford a $400,000 house doesn't actually mean you can afford a $400,000.
Right.
In fact, in most cases, you couldn't.
Approvability does not equal affordability.
No, we're even close.
So some of the national headlines are saying that maybe 2026 there may be a housing rebound. How do you typically see the national headlines stack up with this area specific? If we're having a recession in housing around the country, does that affect here as much, or is here different somehow?
Purely by definition, a national average would take into account Southeast Texas. If there's a decline nationally, you're going to see a decline here to some degree. I will say that the petrochemical industry does prop this area to a large degree because you have very hot paying jobs. So affordability here is better. We lived in Austin for a lot of years and affordability here is different. So we don't feel the effects the same way. Often they're delayed. So it would take a longer running national issue to realize the full effects here. Okay. When I look at the transactions I do outside of Southeast Texas to the transactions I do in Texas and I compare them year over year, Southeast Texas is more stable.
Okay.
I would say that people very much so are feeling the effects of a slowdown here, but it is lessened.
Braden, I have a question for you. Let's just play this out.
Sure.
Hey, Braden, I'm looking to buy a home. I don't know what I'm doing. What do you need from me in order for me to start the approval process?
That conversation looks the same almost always. It starts with an online application. It's going to take you 10-ish minutes to complete. I know that you probably have questions or that you might have concerns. So before I ask you to fill that out, let's have a little bit of a conversation about what you're looking to do, when you're looking to do it. That matters.
That 10-ish minutes matters if you're typing with 10 fingers or 2.
Yeah. Some people might take longer. I try not to do the thing where I'm just sending people links.
Yeah.
Because I think that, I have no chance to build rapport with someone or to show that I actually do care about you. And you're not just a number on a page. If I spend that time and I allow people the chance to ask questions, I can answer them with empathy or compassion. But it also helps me understand the lens to look at their application through. If I know someone is really concerned about something, then I'm interpreting their application in that way. So it gives me a chance to preemptively know what's important to them, their timeline. It's a simple conversation. It's not an interview necessarily, but I just give them a chance to tell me what they're worried about. Right. People feel like it's scary to apply for a mortgage. Yeah. We talk about the fear. What's on their mind.
We greatly appreciate that approach. What you're describing about your heart in lending and helping people. One of the things that we try to help educate people on and warn them of is if you go to an investment advisor and they start pushing products and they start talking about, I can get you this return.
Before they ever know who you are.
Right. Big red flags. What we're really committed to is the same thing that you're talking about. One, we want to truly help people. What is best for the client? That's what it means to be a fiduciary. What does it mean to take care of your clients, to do what's best for them? How can we educate you? You're saying, I don't want to get you into a mortgage that you don't understand. You don't take advantage of their trust. You take that as a serious responsibility, and then you go to help them.
For sure. Also, like what I do is not rocket science. And I wish I went home and told my daughters that I've sent people to the moon or did something wild. But the beauty of that is that the knowledge I have is transferable. with good communication. And so I feel like in most cases, hopefully the clients not only walk away with a good budget and a house and a better understanding of the process, but probably some level of financial literacy that they didn't have before. Just understanding money a little bit better.
Well, and that's the thing. We talked about this before the program. Because of folks not getting taught how these things work at young ages in school, it's not rocket science to us.
Right.
But for them, not only is it a new world, but there's little nuances, right? That you spend the time educating yourself on, learning about, and that whole world's moving all the time, changing. And so being able to keep up with all that and convey it to someone in a marketable, packaged way that they can understand, because they don't live in that world. Braden, thank you so much for coming, man. This has been educational for me, because I don't do this every day.
Thanks for tuning in with us today. Don't let the headlines and don't let rate speculation decide your future.
If you want confidence, clarity, and a strategy that'll work for your financial future, reach out. We'd be glad to help.